In the previous chapter, we briefly discussed that different asset classes, like stocks and bonds, have different levels of both risk and reward. The more expected risk something has, the more expected return accompanies it. As investors, there is essentially a reward premium for owning stocks over owning bonds. The big question for investors is determining what you can reasonably expect to earn, given a portfolio's mix of stocks and bonds, and how different portfolios behave over a long period of time. This chart shows the annual return for different asset allocations between the years of 1926 to 2022, based on the U.S. stock and bond market. On the left, the data starts by showing a 100% bond portfolio, and moving to the right, each mark changes its allocation by 10% until we arrive at a 100% stock portfolio. As expected, the more bonds we have in our portfolio, the lower the annual return is, whereas increasing the stock allocation in our portfolio increases the historical returns. Based on this data, a 100% stock portfolio has had an annual return double that of a 100% bond portfolio. Past returns don't guarantee future returns, but this data can give us an insight into what is reasonable to expect as far as long-term returns. By expanding this data, we can actually see the historical range of returns for each portfolio. Now, this is where things get tricky. In the previous visual, given the options presented, I imagine everyone would choose the 100% stock portfolio since it has produced the highest annual rate of return. But now we can see the full picture and really assess the risk associated with each portfolio. Knowing that a 100% stock portfolio has dropped 43.1% in a single year might be enough to completely eliminate that as an option for you, and I wouldn't blame you. A drop that significant can be a very uncomfortable thing to sit through. But we can see that regardless of the asset allocation, each portfolio does have some considerable downside. Based on similar historical data, a 100% bond portfolio experiences a negative return in about 15% of years, while a 100% stock portfolio experiences a negative return in over 25% of years. We can never completely eliminate risk from our portfolio. Investing always contains some amount of risk, and it has to, otherwise there would be no reward. And if we think about it, even not investing actually contains risk, because if our money isn't growing, then we're actually losing buying power due to inflation. The trick is to understand what risk is, and if you're investing properly, substitute the word risk with volatility. Since we always have to deal with risk, there's no way around it. Let's talk about how it pays to be a long-term investor rather than a short-term investor. In the last chapter, we talked about how time is an investor's best friend. Time on its own can take a properly invested portfolio and turn it into something incredible. But that's not the only advantage of investing for a long period of time. Based on the S&P 500, which would be a 100% stock portfolio, this chart shows the range, spread, and periods of negative return over time. As we can see, the longer we invest, the more certain our outcomes become. The range of possible outcomes narrows, which reduces the spread, and looking at investing for any 15-year period historically, there's never been an outcome that produced a negative return. Another way that we can think about this is on a daily level, there's a slightly better than 50% chance historically that the S&P 500 will be up rather than down. It might not seem like a lot, but slightly more good days than bad days compound in the right direction, improving our odds of a positive result with the more time that we give it, similar to how compound interest can turn small returns into incredible results. The return data we looked at is based on a single year, so it's important to incorporate that information with long-term data, which shows us even more promising results. The longer we invest for, the more risk we reduce, and the better our results become. Our worst case scenario gets better and better with each passing year. When we know what to expect, we can build more accurate plans to get us to where we want to go. This is important because we want to have accurate timelines as well as accurate contribution rates. And if our expected returns are way off, then we won't get to where we want to go on time. Everything has to work together here, and it all starts with establishing expectations for how things should work individually.